Imagine lending your friend some cash. In return, they promise to pay you back with a little extra after a certain period. This simple scenario is a basic explanation of what a bond is. Bonds are fascinating financial instruments that play a pivotal role in the global economy. They serve as a bridge between those who need funds, like governments and corporations, and those who have funds to invest. They hold the promise of regular income, potential safety, and diversification. Yet, like any investment, they come with their own set of risks and rewards. It's a world filled with terms like issuers, coupon rates, yield, and maturity dates. It's a dance between interest rates, credit scores, and inflation. It's an arena where the informed thrive. So are you ready to dive deeper into the world of bonds? Buckle up. In the financial world, a bond is a type of investment. But what exactly does that mean? Well, let's unravel the mystery. Imagine you're lending money to a friend with the promise that they'll pay you back later, with a little extra as a thank you for your trust. That's essentially what's happening when you purchase a bond. Bonds are debt securities, a fancy term which simply means they represent a loan made by you, the investor, to a borrower. This borrower could be a corporation looking to expand its business, or even a government funding a new infrastructure project. But here's the thing about bonds. They come with terms and conditions. The borrower promises to pay you back the loan amount, also known as the face value, at a specific date in the future, known as the maturity date. And remember that little extra thank you I mentioned? That's called the coupon rate, a fixed interest rate the borrower pays you periodically until the bond matures. So when you buy bonds, you're playing a key role in the financial market. You're providing funds that borrowers need to grow and innovate, and in return, you get a steady stream of income and the promise of your initial investment back. In essence, when you buy a bond, you are lending money and becoming a creditor. Quite a shift from your daily life, isn't it? To navigate the bonds market effectively, understanding the key terminologies is essential. Let's start with the term issuer. This is the entity that is borrowing money through the bond. It could be a corporation looking to fund a new project, or a government needing to finance public works. Next, we have the face value, also known as the par value. This is the amount the bond will be worth at its maturity. Think of it as the final destination for a long journey, the point where the bond's worth reaches its peak. The coupon rate is another crucial term. This is the fixed interest rate that the issuer agrees to pay to the bondholders. It's like a promise from the issuer to the investor, a guarantee of regular income throughout the bond's life. The maturity date is the date when the bond will be repaid in full. It's the end of the journey, the moment when the bond reaches its face value and the issuer repays the initial investment to the bondholder. And then there's yield. This is the return an investor earns from a bond. It's the measure of the income an investor can expect to receive from holding the bond, taking into account both the coupon payments and any changes in the bond's price. Each of these terms plays a key role in understanding how bonds work and how they can fit into an investment strategy. The issuer determines who's offering the bond, the face value and the maturity date outline the bond's lifespan. The coupon rate defines the income to be received, and the yield gives a measure of the bond's overall return. By understanding these terms, you'll be able to make more informed decisions when it comes to investing in bonds. You'll know what you're buying, how much income you can expect, when you can expect your investment to be returned, and what your overall return might look like. With these terms under your belt, you're already on your way to becoming a bond expert. Now that you know the lingo, it's time to understand how bonds work. Our journey begins with the issuance of a bond. Picture this as a formal IOU, where an entity, let's say a corporation or government, needs money and decides to borrow from investors. This is the bond issuance. The bond is sold to investors who are, in essence, lending their money to the issuer. The issuer promises to repay this amount, known as the face value, at a specified date in the future, which we call the maturity date. As the bondholder, you're not left empty-handed until the maturity date. The issuer offers a thank you in the form of coupon payments. These are regular interest payments made to you, the bondholder, for the duration of the loan. The rate of these payments, known as the coupon rate, is fixed and agreed upon at the time of issuance. It's like a thank you gift that keeps on giving until the bond matures. Fast forward to the maturity date. This is the day the issuer has marked on their calendar to repay the face value of the bond. It's the finish line of the bond's life cycle, the day when the issuer says, "Thank you for the loan, here's the amount we agreed I'd repay." Now, as an investor, you have the full amount that the bond was initially worth. But here's a twist. What if you don't want to wait until the maturity date? This is where the secondary market comes into play. You can sell your bond to other investors before it matures. The price you get might be more or less than the face value, depending on various factors, including changes in interest rates and the creditworthiness of the issuer. So, bonds are not just about lending and borrowing but also about trading and earning. The mechanics of bonds offer opportunities for both steady income through coupon payments and potential profit in the secondary market. They're a fascinating financial instrument, aren't they? Scene script. Like any investment, bonds come with their own sets of risks and rewards. Let's dive into the risks first. One of the key risks is interest rate risk. When interest rates rise, bond prices fall. This is because, as rates go up, newly issued bonds will offer higher yields, making the lower-yielding bonds less attractive and therefore less valuable. Conversely, when interest rates fall, bond prices rise. Next, we have credit risk. This is the risk that the issuer of the bond will default on its payments. The higher the credit risk, the higher the yield the bond must offer to attract investors. Credit ratings agencies assess this risk and assign ratings to bonds, from AAA for the most reliable to D for those already in default. Inflation risk is another significant concern. If inflation rises, the purchasing power of the fixed interest payments from the bond reduces. So, if inflation outpaces the yield of the bond, the real return could be negative. Finally, there's liquidity risk. Some bonds, especially those from smaller issuers, may not be easy to sell quickly without affecting the price. This could be a problem if you need to sell the bond before it matures. Now let's look at why investors might choose bonds despite these risks. Bonds provide a predictable income stream through their regular coupon payments. This can be especially attractive to those who need a steady income, such as retirees. Bonds are also generally considered safer than stocks. While they may not offer the same potential for high returns, they also don't carry the same level of volatility. This can provide a comforting level of stability in a diversified portfolio. And speaking of diversification, that's another key advantage of bonds. They tend not to move in lockstep with the stock market, meaning they can help balance out the ups and downs of your equity investments. Knowing the risks and rewards, you can make informed decisions about bonds. There's a variety of bonds available in the market. Let's explore a few. First up, we have government bonds. These are essentially IOUs from Uncle Sam or other governments worldwide, promising to pay back the face value of the bond plus interest. They're generally considered a safe bet because they're backed by the full faith and credit of the government. Plus, they come with some tax benefits. For example, interest on U.S. Treasury bonds is exempt from state and local taxes. Next, let's talk about corporate bonds. These are issued by companies looking to raise capital for things like expansion or research and development. The credit ratings of these bonds are crucial. The higher the rating, the lower the risk of default, but also the lower the yield. On the flip side, lower-rated bonds, often called junk bonds, carry a higher risk of default, but they also offer potentially higher yields to compensate for that risk. Last but not least, there are municipal bonds. These are issued by state or local governments to fund public projects like building schools or highways. They're similar to government bonds in terms of safety, but they offer a unique advantage. The interest on most municipal bonds is exempt from federal taxes, and sometimes state and local taxes too, making them particularly attractive to investors in high tax brackets. So, whether you're looking for the relative safety of government bonds, the higher potential yields of corporate bonds, or the tax advantages of municipal bonds, there's a bond out there for you. Remember though that bonds are not risk-free. Each type carries its own set of risks, which you should carefully consider before investing. Each type of bond comes with its own characteristics and appeals to different types of investors. Now you might be wondering, how can I incorporate bonds into my investment strategy? Well, first and foremost, consider the role bonds can play in diversifying your portfolio. While bonds generally offer lower returns than stocks, they typically provide more stability and regular income through coupon payments. This makes them a valuable addition to a balanced portfolio, especially for those seeking a steady income or a safe haven for their capital. When investing in bonds, it's crucial to understand the relationship between bond prices and interest rates. When interest rates rise, bond prices typically fall, and vice versa. This inverse relationship is a fundamental concept in bond investing. Next, consider the duration of the bond, which indicates the bond's sensitivity to interest rate changes. Longer-term bonds are generally more sensitive to interest rate changes, but they often offer higher yields to compensate for the increased risk. Also, make sure to assess the creditworthiness of the bond issuer. Credit rating agencies assign ratings to bonds based on the issuer's ability to meet their financial commitments. Higher-rated bonds are considered safer but offer lower yields, while lower-rated bonds, often referred to as junk bonds, offer higher yields but come with a greater risk of default. Furthermore, consider tax implications. While the interest from corporate bonds is fully taxable, interest from municipal bonds is often exempt from federal taxes and potentially state and local taxes as well. This makes municipal bonds particularly attractive to investors in high tax brackets. Lastly, keep in mind that not all bonds need to be held to maturity. Bonds can be bought and sold on the secondary market, which provides flexibility if your financial needs or market conditions change. By understanding these concepts and carefully considering your financial goals, risk tolerance, and investment horizon, you can make informed decisions about incorporating bonds into your investment strategy. Remember, a balanced portfolio is often the key to a successful investment strategy. Bonds are an essential part of the financial world, providing benefits to both lenders and borrowers. As we wrap up this journey into the world of bonds, let's quickly revisit the key points. Bonds, in their essence, are loans that investors make to borrowers, which can be corporations or government entities. They come in various forms: government, corporate, and municipal bonds, each with their unique features and benefits. Remember those vital terms we learned? The issuer, face value, coupon rate, maturity date, and yield. They're the nuts and bolts of understanding how bonds work. From issuance to maturity, bonds offer regular coupon payments and a return of the face value upon reaching their maturity date. We also shed light on the risks associated with bonds: interest rate risk, credit risk, inflation risk, and liquidity risk. While bonds are generally considered safer than stocks, they aren't without their downsides. Remember that bond prices can fall when interest rates rise, and inflation can eat into your returns. But on the brighter side, bonds offer regular income, diversification for your portfolio, and a safety net during turbulent times in the stock market. They can be a smart choice for investors seeking steady returns and lower risk. And finally, we discussed how to incorporate bonds into your investment strategies. They can provide balance and stability, but it's essential to align your bond investments with your financial goals and risk tolerance. Before venturing into the bonds market, always seek professional advice and make informed decisions. Now that you are equipped with the basics of bonds, it's time to take action. Knowledge is power, but it's only beneficial when put into practice. So, why not delve deeper into the world of financial markets? Explore more about bonds, their types, their risks, and the strategies to invest in them. Every bit of information you learn strengthens your understanding and your capacity to make well-informed decisions. Remember, the world of investing is vast and diverse. Bonds are just one part of it. There's so much more to learn and explore. If you found this content helpful, please give it a thumbs up. It's a small gesture, but it makes a big difference. And don't forget to share this knowledge with others. They may find it just as useful. Lastly, if you haven't already, do subscribe to our channel. We're here to help you navigate your financial journey with valuable content. Remember, the journey of 1,000 miles begins with a single step. Start your investment journey today.